Everybody, and welcome to today's webinar on the Oasis Risk Platform for Asia project. Firstly, I want to give you a quick reminder of the project, which we started in July 2018. Many of you will have attended one of our workshops or events held in Manila with our partners NatRe over the last 2 years, or hopefully you were able to attend the first webinar in this series that we held last month. This entire project is being funded as part of a 2-year project by the German government International Climate Initiative of the Minister for the Environment, Nature Conservation and Nuclear Safety, and it's due to complete by the end of this year. The Oasis Loss Modelling framework is an open source software platform and set of standards for disaster risk modelling. It outputs standardized metrics required for economic and financial risk analysis and risk transfer. My name is Claire Souch. I've got 20 years experience in catastrophe risk modelling in the reinsurance industry, and I'm overseeing the project. I'll also be joined in the presentation again. Those of you who attended the first one will remember Matt Donovan. Matt completed a master's degree in remote sensing in 2008 and has since then held several high management, cat modelling and exposure management roles at RMS, Willis Re and AIG, and led the exposure management function at Lloyd's of London Syndicate DTW 1991 before joining Oasis last year. So today, after a brief recap of the webinar series, Matt's going to take over and give a demo of the Oasis user interface and how you set up the analysis, configure the outputs, and run model using the UI. He'll then discuss the model outputs and what they mean, and talk about some of the applications of the model output in reinsurance and insurance. I'm then going to come back and finish off the webinar with a few examples of how the model output can be used in other applications outside of insurance. This is our second of 4 webinars, as I said, and as many of you will remember. In our first webinar last month, we discussed the fundamentals of catastrophe risk models and inputting the data, the exposure data, that you need to run analysis. That recording is now available on the Oasis YouTube channel, so you can review it back there anytime that you want. The slides have also been posted to our Oasis website. This week, we're focusing on using Oasis, running risk models, and using the outputs in different applications. In our next webinar next month, we'll go into more technical topics such as the Oasis Platform architecture and IT requirements, installing the platform, and our final webinar will cover the flood model, which is being delivered for the Philippines as part of this project. Please submit questions using the chat function to the host only, as you'll see here on the chat screen. At the end of the presentation, we'll answer as many as we can in the time available, and we'll follow up with written responses to others afterwards. And again, a recording of the presentation and the slides will be made available afterwards on the Oasis YouTube channel and website. So Matt, I'll hand over to you now for the demo, and I will talk to you all again towards the end of the presentation. Thank you very much.
Hi everyone, thank you Claire. Hopefully you can now see my screen. So as Claire said, I'm just going to run through the user interface for Oasis and show you a quick and simple demonstration. As Claire mentioned, there are some videos on our YouTube channel. And there has been some pre-recorded UI demonstration videos on there. So after this, if you want to have another look, please feel free to look at those videos. So let's just go ahead and start. I'm just going to log into the UI now. And hopefully you can all see this. This is the home screen for the Oasis user interface. So just a few details here. These are all pre-analyses that we've run previously. If you want to go back and look at your work in your analyses, and some nodes here. So this collapses things, and we have a few tabs here. So if I just go ahead and start, so we want to basically start a new analysis. So single analysis, and we want to create a portfolio. So just go to create portfolio here, and here is a list of all previous portfolios we have created. So I'm just going to go ahead and name this whatever we want. Let's call it UI test and submit. And as you can see, just collapse that. As you can see, the UI test portfolio is now listed here. So just going back to the first webinar we showed last month, and we went through all of the different exposure files and data inputs. So that's where all of those would be inputted here. So our location file, our account file that has all our financial insurance terms, and then any reinsurance information. So just for this instance, I'm just going to go ahead and upload and browse to a location file. So here's one I've been testing on. This is a really small test portfolio of UK locations. It only has 15, so you can see it's uploaded pretty quickly. And just recapping, the location file is the only compulsory file required to run a model and to get ground up losses. And if you want to apply your financial terms, you would need to upload your account file and then obviously any reinsurance. But for this example, I think we're just going to do locations. So that's uploaded pretty quickly. And if I just go to proceed to choose analysis. So what we have to do now is create an analysis name. So go to create an analysis, and we call it again UI test or anything we like. And just before I submit that, you can see that this is where you would have a list of the models available to you. So in this instance, I've got 2 test models, an earthquake and our test wind model for the UK. So obviously you just choose which one is appropriate to you. And just before we do that, if you go to show model details, here is actually a simple snapshot of what is included in that model. So information on the event set, the occurrence set, and all of the sub-perils that are included within the model. So I've chosen that right model, I've named it. If I just hit submit, you can now see that it started the generation input here. And because it's small, it should only take a few seconds. Obviously, larger portfolios will take longer. So if I manually refresh there. Okay, so there we go. So it is ready now. Before we configure our output, I'm just going to go back and show you a few things on the exposure. So before we've even started running a model, you can actually go to a validation summary here, and it will give you all of your front end information on what has been imported and what your data looks like. So here we've got our TIV, which if you remember back to the first webinar is your total insured value. And for this instant, it's £3.4 million. But we've also got some non-modeled TIV here. And so if you look down, we've got total number of locations is 15, but we've actually got 5 that have failed. And I'll explain why in a second, but we have 10 that are successful. And here it actually shows you the success rate of your number of locations and your TIV for 2 perils. So in this model, we have a storm surge and we have tropical cyclone. So the green represents the success rate for the number of locations and TIV, and we've got those 5 locations that have failed. So we can also go to a validation map and see these exposures on a map here. So you see if I zoom out, we're in the middle of the UK there. And we have the 15 locations. So we have 10 over here that are in green, which are the successful ones, and those in red have actually flagged up as failed. So I'll come back to the failed ones in a sec. If we just click on this location here. So this is the location that has our 10 risks. And if you click on each point, it will actually give you the associated exposure information and street address information with it, with associated TIV, which is quite handy to look at when you've got thousands of locations in a close vicinity. So if I just zoom out, the reason, and I've done it deliberately, is to show you these locations that have failed. So these are actually, they fall out of the scope of the model. So the model only covers that one town, and these actually fall outside. And if you click on each one, it will actually give you an error message and tells you why it's failed. I mean, we know because it's outside of the geographical scope of this test model. So it's just a way of seeing your location. So this is quite good, especially for a non-insurer as well, and for people at local authorities who could actually look at their vast amount of locations or risks in a small place or in a city. So just to show you another couple of functions of the map. So here we can have, so zoom back in a little bit, we can actually start drawing some circles. So essentially, I could just draw a large circle and it gives you your radius there. So this is just over 5.5 kilometers. The total TIV, so all 15 locations, and it will actually give you, just expand that, actually give you all of the locations in that circle. So this is a really good function for trying to identify your hotspots or areas where you have quite a lot of exposure. If we draw another one, I can then actually draw an overlapping one there. And if we click on that, that will then change to the 10 locations. If I click back, it will show the 15. And also within this, you can actually change your damage ratio. So this is showing 100% of the TIV. If we wanted to have a look at, say, 50%, that will then change your TIV by half. And we can also look at accumulations by country. So we can click on a country and it will tell it by country. And we can also look at subregions of those countries if we wanted to. So that's the mapping function. And also, before we start running a model, it's quite important to show you the inputs. So this is, in the interest of transparency, and because Oasis is open source, it gives the user, and certainly the technical user, abilities to look at the technical information and some of the code behind the scenes. So these are some of the JSON files, which will make more sense to the technical audience than it will do to the non-technical audience. And this then gives those people the ability to really dig down into what's going on and looking at the model. And you can export those as well. So there's quite a few here, and it'll give you any errors as well. So we look at those, and these are the 5 locations and the associated perils that we know have failed, and it will give you the information behind why they've failed. And also you can export them as CSVs, and you can do some analysis and analytics outside of the UI. So it's quite transparent, and there's, you know, we're not hiding anything. Everything there is, all the important stuff is there to look at. Okay, so that's the exposure information. If we then go ahead and try to run the model, so first of all, we have to configure our output. So if we go to output configuration, what we have here is we decide, or the user then selects what outputs they want to see. So they want to see modeled losses by different exposure attributes or different parts of the exposure. So we just have to set that up before we actually go ahead and run the model. So on the left-hand side here, we have just the model parameters, so we can set our loss threshold. If we don't want to see anything below, I don't know, $1 million, for example, you can just set that to $1 million and it will just get rid of any of those losses that are below that threshold. And then number of samples. So I'm going to go through what outputs mean and something a bit more technical about sampling a bit later. So we'll leave that as the default of 10 samples for this instance. And here we have the output parameters that we want to set. So here we can have the different perspectives. So you've got your ground up, your insured and your reinsurance, and they all show here. We'll untick those because we're just showing our ground up. And this is for all risks. So at the summary level, this is for all risks, and these are our basic reports, our AAL, AEP, and OEP. And again, if you're not familiar with these, just bear with me and I will be going through them after the demonstration. So let's say this is at the all risk level. Let's say we want to dig down further. We can actually drill down into more detail. So again, we can change our perspective or add our perspective and the summary level. So let's say we want to look at our losses by construction. We can actually choose construction there, and it will add down here, and we'll get those 3 major reports by construction and again by all risks. Or we can add some more. We can look at occupancy, for example. So occupancy there, and that again will add to our list of reports that are going to come out. So you can start building quite a detailed group of reports, but we can actually dig down even further to the next level. So if we go to customization, again, we can choose, let's say, our construction, but we can also now choose what sort of reports we want to have. So we can start looking at PLT or AAL, OEP curves. Again, don't worry about what these mean for now. And we can start adding more as well. So again, we can look at our occupancy, and we can choose a different set of reports for occupancy. And we can actually start building quite a lot of reports and get into quite a lot of detail. For this example, we're going to keep it simpler. It takes a bit of time to run as well. So I'm just going to run it by location. There's only 15 locations here, so it shouldn't take too long. Obviously, if you've got thousands of locations, running it by location will take a bit of time. So there, we've set it up. We're going to run it by all risks, which is a default, and then also by location. And then once you're happy with that, it's just execute run. That then you can see the run has started, and hopefully it shouldn't take too long because we're only running a small portfolio. If you bear with me a second. So if I manually refresh there, so run completed, obviously that would take a lot longer depending on your portfolio. So at this stage, if you realize, oh, actually there's an output you haven't turned on, you can go back to rerun and you can choose it again and rerun your analyses. But we're happy with this. So we want to now look at our outputs. So if we proceed to dashboard, these are now your model outputs. And again, you've got your summary information on location count and TIV, and then you have your loss curves. And these are essentially your fundamental modeling outputs and your AAL. And you've got both analytical and sample outputs here, which I will go through again. So you can then customize your plots. So we want to choose perspective, OEP, we can call it whatever we want, and we can look at all risks. So this is the plot for all risks, the OEP curve. But then because we ran it by location, you can actually choose this location here, draw a plot, and you will see all of your loss curves by individual locations. And these all can be exported as a PNG and put into any external reports or reporting software. Obviously, we've only got 10 locations here. So if I was to run hundreds of locations, that would look quite messy. So it might be better to export it and do your own sort of analysis. We can also then look at our AAL. That's just a big block because it's all risks. But then if we change it to location, you can then see your AAL, which is your average annual loss. Again, I'll go into it a bit later for each location. And finally, because I have run this by location with location level output turned on, we can actually see these on a map. And you can see you've got a slider there to choose your range of losses. And if I draw a plot, you can then see it goes to that same map. And if we zoom in, it starts giving you the loss by location for that chosen return period. And it also has location ID. So you're able to then go back and check what location that is in your exposure information. So that's quite useful to see, especially if you've got a portfolio of hundreds of locations. You're able to then dive and have a look into individual risks. Okay, and finally, just coming towards the end of the demonstration, finally, here's the Files tab. Now, this is the bread and butter, really. This is the output of the models. So this will come up with all of the options you chose previously. So we've got location. So I can then click on that and view that file. And it will have all of my information here. And you can then export that as CSV. Open it up, and then that will give you all of your return period losses and your EP curve, which then you can do whatever you wish with. So if I just go back, we'll just look at one more. We've got the AAL, which we chose for all risks again. And there's our file. So there's quite a lot, and obviously the more output you have chosen in your configuration, they're all the results you're going to get. Okay, so that's the end of the demonstration. Hopefully, I think you'll agree, it's fairly straightforward once you've used it a few times. You know, running a model, importing data and running a model in the UI is actually quite straightforward. And like I said, this video will join the other videos on the YouTube channel, and you'll be able to have a little look yourselves. So if I continue with the presentation, and now you've seen and got an idea of the feel of the Oasis UI, I'm just going to go through some of those key modeling outputs. Now, I appreciate for some of you listening, this is probably quite familiar. but I think it's worth going through and just explaining what they are, as I'm sure there are some of you on the call that aren't as familiar with modeling outputs as others. So I've mentioned it before, the AAL. So this is the average annual loss, and it's also referred to as the pure premium or the mean loss. And from an insurance perspective, this is essentially what the model says your losses, your average amount of losses on a year are going to be. So for an insurer, you need to be generating, according to the model, you need to be generating at least this amount of premium for either a policy or an account or a portfolio to make a profit. So if your AAL is higher than your premium for whatever you're looking at, it means that the model's saying, you know, you're going to be losing money essentially. And the AAL is a fundamental output of a model, and it's also sort of a starting point for a company where they will then start to load other aspects of losses such as fire and theft and capital and anything else that goes on top of that. And again, I'll come to the application of these outputs a bit later on. Other key outputs is the OEP. So this is the occurrence exceedance probability loss, and this is the probability of exceeding a loss from the single largest event in a year. And then we have the AEP, and again, it is the aggregate exceedance probability, and this is the probability of exceeding a loss from all events in a year. So looking at those two, the AEP will always be either the same or more than the OEP, just because you are looking at aggregate number of events rather than the OEP, which is just the single largest loss. So let's go on and look at return periods. So return periods, these are points on your OEP, AEP loss curve, and they represent the severity of the loss along that curve. So sort of some basic maths. A 1 in 50 year event has a 2% probability of exceeding a loss in a given year. A 1 in 100 year loss is a 1% chance, 1 in 200, 0.5, and 1 in 500 is a 0.2% chance. So got a loss curve here. We have return period along the bottom, and we have the loss on the vertical y-axis here. And here is the 1 in 200. So the way to look at it is that according to this loss curve, there's a 0.5% chance of exceeding a loss of at least $1,500 in any given year. That's what this is saying. So for return periods, it's actually better to think of it as a probability. So just on the side here, I've written, you know, a 1 in 50 year loss could actually occur in 2 consecutive years. So it's better to think of it as a 2% probability of exceeding a loss rather than thinking of it a loss that occurs every 50 years. I know that might seem quite obvious, but a lot of people see this and say, oh, it happens every 50 years. But mathematically, okay, you know, the probability it does, but it can happen multiple times in a year. And just want to move on to standard deviation. So this might take a lot of you back to maybe high school maths. And standard deviation is the distribution or the variability of losses around the mean. So on the left-hand bell curve we have here, this is quite a steep distribution where a lot of the losses are actually quite close together. And this represents a lower standard deviation. And it basically represents lower uncertainty because everything is a lot closer. Whereas on the right-hand side, we have a lot higher standard deviation where there's a lot more distribution and variation around the losses and around the mean. So you're producing a much wider bell curve, and this is representing a greater amount of uncertainty. So I suppose it depends, but from a modeling point of view, you obviously want to prefer the one on the left, depending on the situation, because you've got less uncertainty there. And again, I went through a couple of these very briefly on the user interface demonstration to show you the outputs. So these are outputs you can choose. So your ELT, these are your event loss tables, and it's your losses per event in the model. And they're essentially quite a large CSV spreadsheet, and it has a loss for every event, and it contains a mean loss and the standard deviation. So if the model has 10,000 events, you know, you will have a loss and a line of information in a CSV file for every event for 10,000 rows. We also then have the PLT. So this is the period loss table, similar to the ELT, but this is based on losses across a period. Period is usually a year, but that can differ depending on the model, and it is specified. And each period will contain a specific set of results, of events, beg your pardon, for that model. We then now move on to analytical and sample outputs. Now, I did mention these again in the UI, and I just want to spend a few minutes talking about the differences between analytical and sample. And I appreciate some of this might be quite new to a lot of you, so I'll try my best to explain it, but then if you do have questions afterwards, we can readdress it. So analytical outputs are essentially the basic results and the losses across the entire distribution. And this is the recommended output for your ground up losses. So when you're not applying financial terms. And opposite to that, or next to that, is the sample output. So some of you might know this, but sampling is based on a Monte Carlo simulation, and it essentially randomly samples distribution of the events. So the distribution of each event we call the effective damageability distribution. And this essentially is a distribution for every event that covers the uncertainty around hazard intensity, vulnerability, and exposure. And so what will happen is each event will be sampled n times, or however many times we chose. So when I was showing you the demonstration, we kept it on the default of 10 samples. So when we ran that model, it basically would have sampled every event in that model 10 times to give you an idea of the distribution. And the sampled losses will then be a mean across those 10 samples. And this is the recommended view when looking at your insured losses, or your the losses when you've applied policy terms. And I'm going to explain now a bit more and try to help explain what I mean. So here we have a standard distribution of losses, and then we throw in a mean. So this is the analytical mean, or the standard mean across this entire distribution. And like I've said, this is okay for using your ground up perspective. We then throw in a few samples. So here we've got a set of 6 samples, and these are essentially 6 random snapshots of the losses. And so at this stage on this distribution, the analytical and sampled means might be quite similar. There might not be much in it. So that's fine, right? So what happens then when we want to apply some financial terms and look at our insured perspective? So here then I throw in a deductible. So this policy deductible determines what proportion of the losses the insured is actually responsible for covering. So it might be the first X% of the loss, or it might be the first X amount. And so what happens is this deductible, for this example, has now actually essentially wiped out that analytical mean. So anything left of that green line of that deductible is essentially wiped out, because the deductible is the responsibility to be covered, those losses, by the insured. And so if we looked at the analytical mean here, it would actually be 0, which we know is incorrect, because the analytical mean is looking at the entire distribution. We've then essentially cut it off with the deductible, and it would give a zero result. And this is actually then also wiped out the first 3 samples. So across this whole sample set, you're going to have sample 1, 2, and 3 as 0, and then 4, 5, and 6 as a positive number. So wiping out those first 3 samples, like I've showed here, will actually have a significant impact on the mean losses across all 6 samples. So I hope that sort of makes sense. That sort of highlights why you need to look at your sample losses for your insured perspective. And so essentially looking at this now, what we do for this example really is to basically increase the amount of samples. And this will then give us a much better snapshot and picture of that distribution, which is net of your financial terms. So I hope that sort of makes sense to most of you. And I'm just going to move on to, how many samples should I run then? I mean, that's a very difficult question to answer. And again, it's heavily dependent on the portfolio. And I'm going to show some examples of what I've done. So I've just put some notes here for you to use. So for a large varied portfolio that contains different types of properties, and they might be in different locations, looking at the portfolio level, running upwards of maybe 1,000 samples might be required to give a good enough representation of the losses. Because there's going to be quite a lot of variation, you want to have quite a lot of snapshots of that to give you a good picture. But then running a portfolio with maybe a large portfolio with 1 million locations, which are all homogeneous and similar and in the same region with very basic financial terms, you might get similar results running 10,000 or 10 samples, just because the law of large numbers will kick in and there won't be much variation between those very similar properties. And so it doesn't really matter how many samples you run. But then conversely, you might have one single risk, which is a really large, complicated industrial site, which has very complex damage functions and quite a complicated financial term to apply. And to get a really good snapshot or really good picture of those losses, you might have to run tens of thousands of samples. And so it's a very difficult question to answer on how many samples to run. So a good indication is you can run the analytical and sampled outputs for your ground up, which we did in the UI, and you can get both those perspectives out together. And a good indication would show that if the sampled output and the analytical output were quite close for ground up, it shows good convergence, is what it's called, between the samples, which shows that actually the sample set, depending on how many you've run, and the analytical are quite close, which shows that there's good convergence. If they're not close and there's a lot of disparity between those two, it shows that it's actually a poor representation of the losses, and then you may need to increase your sample set. And I've just put a note down here on this slide to say it's, if you're running tens of thousands of locations with tens of thousands of samples, that's actually going to affect your model runtime and also increase the size of the database. So here's just an example I've put together to help explain what I've just been talking about. So what I did is I ran a few model runs and just changed the sample set for each one. So for example, one, which is represented in blue, it was a 12,500 location portfolio, and I ran it through the same test model for a UK wind, a town in the UK, and it had very basic vulnerability functions. And so you can see on the graph here, the difference in losses between running 10 samples through to 10,000 samples is actually quite small. There hasn't been much change between them. And this is going back to what I was saying about having a large portfolio, but that are quite close. There was no financial terms and the vulnerability functions in the model were quite basic. It shows that the distribution of losses between those samples are actually quite similar. And then we move to example 2, which is shown in green here. And this was the same test UK wind portfolio, but only for 10 locations rather than the 12,500. And as you can see, after running 100 samples, from 1,000 samples onwards, the green bars are quite small. So, the losses between each sample set is actually quite small. So this is showing there's actually good convergence in samples the more samples you run, essentially, because you've only got 10 locations. The differences in results are larger when you're only running less than 100 samples. And then finally, example 3 here in orange, we've got another small portfolio of 50 locations, and we've run them through a Dominican Republic earthquake model, and they have more detailed vulnerability functions, and the results are actually similar to those of example 2 in green, where the sample results actually converge quite closely with the more samples you run. So you can see from 1,000 onwards, like in green, they are quite small. Now, it's just worth bearing in mind, although for the first sets of 10 and 100 samples, we are seeing some difference. Now, it's worth bearing in mind, if you look at the scale on the left, we are talking sort of plus and minus 0.3%. So the changes in losses are, for this example, very small. And so although the graph might look like they're changing quite a lot for 10 or 100 samples, we are talking 0.3%. So they are small, but this is just a way of showing you how results change depending on the number of samples you run. Okay, so that's all I was going to talk about for model outputs and sampling and analytical. So again, I appreciate there's a lot of information I've sort of thrown at you there. So, please feel free to ask any questions afterwards or offline, and we can answer them. So before I pass back to Claire, I'm just going to run through a couple of slides on application of modeling outputs. And these are sort of a high level overview of basic model application functions that a lot of companies in insurance and reinsurance will use the model for in their business. So outputs can help a company determine their risk appetites and their capital allocation. So a lot of companies, a lot of insurers will use return periods, and it's common for them to use certain return periods for setting their risk appetite. And they sometimes refer to these as their PMLs, or their probable maximum loss. And like I said, these PMLs, these can help a company set their threshold for what business and how much business they want to write for specific classes in specific regions. And this will then also determine how much or what benchmark they will be looked to purchase reinsurance at. So in the London market, in my experience, a common market PML for California quake, which we know is a high hazard peril, is the 1 in 200, so the 0.5% probability. And for North Atlantic hurricane, it's usually the 1 in 100, although I have seen some companies also use the 1 in 200. And these are quite severe losses. These are quite far down on a loss curve. So these severities actually give regulators and the company confidence that the company can remain solvent and essentially not go bust if they are hit by quite a severe event. And model losses from CAT models also help support the reserving and actuarial teams, certainly when it comes to reserving capital and putting aside capital to cover potential losses. And these model losses, these are the sort of first steps in the company's work and exercise on developing their final capital requirement. So they'll have all of their reinsurance costs, expenses, outgoings, everything will be piled and loaded onto these initial model losses to help develop their financial bottom line and help develop what capital is required to cover everything that they potentially see as risk for their company. And it's not just setting risk appetite and benchmarks. Models are also really good for performing analytics and for portfolio management and optimization. So you can run a model and look at the outputs and also the inputs as well, the exposure, a bit like on the map, like I showed you with the accumulations, to help identify areas of specific high risk. So you can then start identifying losses in certain regions that might be too high, or losses from certain constructions. And then you can also identify areas of the portfolio that need remediation and that need work, going back to your modeling metrics. So one of the companies I worked for previously, as a part of our risk appetite, we decided we're not going to write any wood frame buildings within a mile of the coast, certainly in Florida, for obvious reasons, because the vulnerability was too high. So we used the model to determine why we came to that decision. And what the underwriters can do is they use model outputs with their underwriting metrics. So one of the obvious ones was looking at your AAL against your premium. And I mentioned it previously that if your AAL is higher than your gross written premium for a risk or a policy, then the model was determining that that risk or policy is non-profitable, and you therefore should probably either change it or non-renew it. And you can also start looking at things like marginal impact analyses and quoting. So a lot of companies will model new risks before they've actually written or bound them. And these are pre-binds or quotes. And you can then perform marginal impact analyses by modeling these new risks that you might want to write and see what impact they have on your existing portfolio. And that might help determine the underwriters choose on whether they write that business or not. And you can start focusing on certain lines of business, geography, construction, and like I said, distance to coast, certainly for, or distance to water, certainly for flooding or for wind. And again, reinsurers will also use model outputs during reinsurance renewals, and they can run and test various and complicated certain reinsurance structures against the company's portfolio to see how the losses are changing and how they are impacted by different reinsurance structures. Okay, so that brings me to the end of what I wanted to say. So I'll now pass over to Claire, who will finish up with the application of models outside of the insurance space. So thank you.
Thank you very much, Matt. And that was an excellent and clear and comprehensive discussion there of the outputs of the Oasis platform. So let me just go back to the presentation. So in this slide, I simply wanted to show graphically the concept of risk transfer as a method of smoothing loss experiences from natural disasters. And this can apply at multiple different levels, and it can also apply to multiple different types of financial mechanisms. Now, although this graph shows a specific example of excess of loss reinsurance, really the same concept applies, as I say, at multiple different levels of insurance or reinsurance and many different types of financial types of cover. I know, and as we all know, major disasters are very volatile, they're unpredictable, and they happen infrequently. So in one year, you may have a very severe loss or several losses, adding up to a very large total. So that would be the AEP if you have multiple losses, like Matt said, or a high OEP if you have one single very severe loss. And other years can be very quiet. So you see here the black line going up and down, which represents different years over time and the loss experience over time, peaking and troughing by different amounts. Now, the retention level here that was set, the bar there at 5 million, for example, you would set that retention level using the PML analysis that Matt just described. So that retention level will always be specific to the bearer of the risk, and it depends on how much money, how much loss the owner of the risk, the bearer of the risk, can afford to pay out themselves. Everything above that retention level would get ceded to another party and would be reimbursed by that other party, of course, for a cost, and that price is set using the AAL model output, that average annual expected losses, as the starting point, with a measure of the standard deviation of the uncertainty, and then loading for other factors, other perils, and the cost of capital and profitability and that type of thing. Now, of course, this pre-arranged financing, it has the effect of smoothing the loss experience for the owner of the risk. So that could be a business owner or a householder, or it could also be at a national government level. And this slide simply shows that range of levels at which risk financing schemes can operate, from the macro level, which will be national or even international, so risk pools. There are several examples around the world where risk pools have been set up across multiple neighboring countries where they share the risk between them. So there's very successful schemes in the Caribbean and the Pacific of risk pools that have been set up for typhoons and cyclones. And other sovereign schemes, such as the Africa Risk Capacity Against Drought, is another example of that type of multinational macro level scheme, where the government is really the insurer. Well, the government is the risk owner and is benefiting from risk transfer and risk insurance. Then you have meso level applications. These usually apply at some sort of aggregator level, such as banks or cooperatives or SMEs. So anything where the where risk is being aggregated, so banks obviously insure or give mortgages across many properties across the country. And then you have micro schemes, which is talking about the direct insurance of individuals, often low-income individuals. And I know in the Philippines this is quite well established, particularly in agriculture and for farmers. And there's a lot of work going on internationally that we're involved in the establishment of micro-insurance around the world. Now, of course, outside of insurance, these models also have several applications of use because the fundamental information that comes out of them gives you a deep understanding of risk. So as well as the metrics that Matt described that are output in terms of the EP curves and the average annual losses, we can also output hazard maps like these. These are examples shown for America. They are they've been created. This model was created by the same organization that's involved in the Philippines flood modeling. And so you can output return period hazard data for different return periods, which helps with planning, for example. So here we see a 20-year return period flood zone, 100-year return period flood zone, and the differences between the two. And you could use these, whichever return period it's agreed on, for thinking about planning and development. And as I'll show in the next few slides, you can start to incorporate future climate change scenarios into those, so that you know what the 100-year return period flood zone is today and what it could be in the future and how that's likely to change. So it can be used in planning decisions, but also for investment decisions in things like flood defences. Because the models are relatively quick to run, you can actually input different data sets to analyse what the impact is of building flood defences or new flood defences on these 100-year return period flood zones. And you can visualise the impact and the difference between them. You can also run what-if scenarios, also for real-time event analysis. So a what-if scenario, you can look at a very specific area, such as a specific town or county, and ask, what if a Cat 4 typhoon hits this area with these specific characteristics? What if a typhoon that had made landfall many years ago hit that area now, today, with today's building stock and population and infrastructure and all that type of thing? And you could also have a forecast. If there's a typhoon or a cyclone about to make landfall, you can use that forecast track and wind footprint to estimate what the expected losses might be or the expected impact might be from that specific storm. Now, talking about the economic impacts of projected climate change, this is another example shown again by one of the organizations involved in the project for the Philippines. We don't yet have this information for the Philippines because we haven't finished the project yet, but this is again another example that was done previously elsewhere. And in this example, it shows the impact of sea level change on potential losses. And we go from what the sea level was in 1900 to the current sea level in the middle, and then a future sea level rise of an increase of 30 centimeters. And in this case, we can see that purely just to that alone, so this is using today's building stock and population in all of these three scenarios. So we're just changing the sea level rise. You see that it increases the average expected loss from 4 billion on the left to nearly 7 billion on the right. And you can see what the impact is as well on the key return period metrics, such as the 100-year loss, or a very extreme event, 1,000-year return period loss, which is often used for very flood-prone areas. You want to protect up to very high return periods if you have a lot of exposure. You can see the impact and how that's changed between 1900 sea levels, the current sea level of the base, and the future sea level rise. So some very significant changes. And as I said earlier, putting this all together, we can look at the economics and cost benefits of different adaptation measures. This was an example that a case study that we were involved in last year in November 2019, released in association with the ETH of Zurich, Insure Resilience and the Insurance Development Forum. And in this analysis, we worked with a consortium of scientists, and we discovered that by 2040, the combination of economic development and climate change could more than double the annual expected losses to $7.4 million from under 4 today. So we have a big expected increase in expected annual losses due to floods by 2040 due to that combination of factors. Now, with the model being able to input different data and information, we were able to test which adaptation measures have the best cost-benefit ratio in reducing those potential future losses. And we found that by simply 2 of the most cost-effective physical adaptation measures in residential housing, applying those 2 would reduce those potential future losses. It would cap them and bring them down by 25%. So in 2040, we would expect the aggregated estimated losses to be over $100 million on the left, but actually if you do implement these adaptation measures, that would be reduced by 25%. We can show that if those adaptation measures were implemented, it would also have the impact of reducing insurance premiums. Now, of course, as we've seen through the model, the output of the model reflects the risk, and it reflects the combination of the hazard and the vulnerability and the existence of any adaptation or protective measures such as flood defences in estimating what the losses will be. Now, the output of the model is used, as Matt showed, in things like pricing of premium. So if your risk reduces, your premium would reduce as well. So by taking these adaptation measures to reduce potential future losses, we can also quantify that, how much that will translate into insurance premiums that would be saved. So that brings us to the end of this presentation for today on the model outputs and using the model outputs. We've shared just a few examples here. There are, of course, many more, both within insurance and outside of insurance, and in the application of development planning, cost-benefit analysis, and future climate change impact analysis. We will take some of the questions now. I just want to let you know that our 3rd webinar will probably be in about a month's time. As I said previously, this is going to be about architecture and deployment. So it's very much aimed at very technical software engineers, IT scientists, people who are going to be building their own models and deploying them onto Oasis. But of course, everybody is welcome to join. And again, all of the webinar recordings and the videos will be posted to the YouTube channel, which you can see here. The link is here as well. We'll email these out as well. So now we're going to have a look at some of the questions.
Hi Claire, sorry, Matt. This is Matt. Yep, sorry. So we've just got the one question. It's probably one more for you, and it's focused on the Philippines model. So the question: does the Philippines model consider flood protection, and also what is the resolution of that model, if you know?
Okay, thank you, Matt. Yes, well, we will in our 4th webinar of the series, which will therefore be towards the end of July, go into a lot more detail on the Philippines flood model. So that presentation will be entirely dedicated to the model, the flood model methodology and resolution and all these types of questions. But just to quickly answer these questions right now, the first question being, does it consider flood protection? Yes, it does. So it does include, so that the flood model covers the entire country of the Philippines, including all of the islands. And it does include information about flood protection measures. However, I would caution that that information is not always, the information that's available to the people developing the models is not always very high resolution, and it's not always completely accurate. So the model and the Oasis toolkit also comes with the capability to override that information and input new data, if it's available, about the existence of flood protection measures. So if the information in the model that has been used goes out of date, you know, some new flood defences are built, or it is actually incorrect, the user can very easily input new information about the flood protection measures. And also, as I just described there, you can test, if you're thinking about building new flood protection measures, you can test what the impact would be by simulating that in the model and run the model with and without those new flood protection measures to see what the impact would be on the flood hazard and on the potential losses. The other question there that was about the resolution of the model, well, we're using what's called a variable resolution grid because the country is so large. You know, the model file sizes are extremely large, and the resolution for modeling flood can be very, very high because flood hazard changes very quickly over quite short periods, quite short distances, especially where you have changes in topography, for example. So the model will imply a variable resolution grid. This means that you can have very high resolution models, modeling where it matters most. So that's where you will have concentrations of exposure and where the hazard does change very rapidly over short distances. And then you can have lower resolution modeling where there's less interest in analysing the details. You will still, over that entire area, have a good representation of the risk is, but it won't be as detailed down to a few buildings as it would be in the highest resolution areas. So that's a way of balancing run times and file sizes and the amount of detailed information that we need and frankly is available to us on things like flood protection measures, with getting the analysis as detailed as possible where it's of most interest. Are there any other questions?
Okay. So yeah, one, sorry Claire, one just has just come through. So I've mentioned the difference in runtime, the difference in number of samples used. So are we talking minutes or hours? Very good question. How long is a piece of string? I suppose if we're talking, like I said in the example I showed, I ran 10,000 samples for that 12,500 risk portfolio, and I think it took about maybe 5 minutes. If we do have some clients, some large clients who run tens of thousands of samples over millions of locations, and therefore you're probably talking hours, I would say. Depends on the model you're running, but the Oasis engine runs pretty quickly. It's pretty efficient. So yeah, we are talking, you can get up to maybe a few hours depending on the large portfolio, but I would say an average size portfolio with say 500 to 1,000 samples would be around minutes, 5-10 minutes, something like that.
Okay, thank you, Matt. And I think that's it for now for questions, but please do feel free to email any further ones through, especially when you've reviewed the web, the YouTube information. And we will be back in touch to schedule our third webinar, which, as I say, will be in about a month's time. And thank you very much, everybody, for joining us today.